Adrian, thank you so much for joining us today. This is the second time that you've come onto the podcast, and we really appreciate it.
My pleasure. Nice to be here again.
Yeah, thank you, Adrian.
The first podcast was very much about your journey around Tech One, some of the high-level things that you learned. And we got some really good feedback from founders and investors around just some of the little operational snippets that you threw out there. So today, what we're hoping to do is go into more of the operational items. And I think it's important to just put up front that Adrian's a venture partner with Tribe and a shareholder. And we've really appreciated the insights and the value that you've brought to not just the investments that you're in, but the insights that you've been able to bring to the other investments with some of the systemic, ideas that you've helped us implement. So we very much appreciate that.
And also the insights for Tribe itself, always catching up with you, Adrian, that there's a new nugget of wisdom or a new way of expressing something and always helping us to find more clarity as well. So those insights have been incredibly grateful to have those insights as well.
Oh, thank you very much. I think with many years under my belt and a ton of mistakes, I think you do learn a few things. So I'm glad it can help.
So we were talking before about until you can forecast properly, until you can drive accountability, you don't yet have a company that you would consider, in inverted commas, valuable. Could we maybe start there and give a view of what is value on some of those items that we can then pull the thread on?
Yeah, no, that's a good place to start. I think they are interrelated, the two concepts of accountability and forecasting. But let's start with accountability. I think if you're going to build a successful business, you have to have accountability. It has to start from the very top of the company, and it's got to drive down through the whole business. And there are some interesting techniques that I have used to make that happen. But to me, I have seen two types of founders. The founder who pretty much, want a better word, hides behind the CFO. So the CFO is used as a shield. And then the founder that stands up and is proud and takes it, both the good and the bad, and they are centre and front of what the company is doing. And I have always seen that the first works much better than the second. And I think it's about the founder being accountable, saying, I'm accountable, and if it works, that's great. If it doesn't work, then I am responsible. So it will drive through the business. So to me, that is really important. And how do you create that culture of accountability is critical.
And often once a company has brought investment on, I guess the rubber hits the road in terms of external influence through the board or through the advisory board. And the connection point often during those meetings is around the reporting that the management provide to the board and therefore the shareholders. What's your view on what should be in those reports? How should founders go about it? What should investors be doing to influence what goes into those reports? Because we see it being functional at times, and then we see it being incredibly dysfunctional with thousands of pages of information that just isn't helpful.
Yeah, no, again, it all ties together. It's a good question. Basically, I think less is best. I'll start with that. I think when you're dealing with boards, investors, particularly both private and public, it is always less is best. And to me, you don't want to be hunting through the board pages to find the salient information. For example, the company's missed its numbers, but it's buried like in the financials, and the CFO sort of fronts that up. That's just crazy. I believe that the very first page of the board pack should tell the story on one page, and it should be very clear. And then basically by scanning that one page, you're able to decide what sort of board meeting you're going to have. You're going to have a relaxed board meeting because the numbers are great, or you're going to have a very difficult board meeting because the numbers aren't great. And you want the CEO to be the person that fronts that one page and can talk about it. And what goes on that one page is really important. Driving probably down a little bit more detail on that one page, because I think that tells the story. As soon as a raise is done, the very first thing I'd like to do with the founders is to sit down and talk about the one page and what should be on it, and to run the business pretty much off the one page. We ran Tech One off pretty much one page, and that's a big $5 billion company. So it can be done. And like, to me, the very first thing on the one page should be, what is your strategic metric for the next 5 years? So if you're a SaaS business, it should be your ARR. So what's your ARR for the next 5 years? And put them there at the top. So everyone in that meeting knows where you're going. And hopefully the conversation will move fairly quickly away from this year's numbers to how do we get the momentum and the flywheel happening to get the numbers for year 2, 3, 4, and 5. So if you're doing $5 million ARR and you're trying to grow at 70% a year, that $5 million is going to become something like $40 or $50 million worth of ARR. You better be thinking about how you do that. And so you don't want to lose sight of that. So that would be the first thing on the one pager is the ARR for the next 5 years. Then the next thing would be, what is the ARR for this year? And what are you forecasting the ARR to be for your key metric? Because that should be the conversation. Are we going to meet that ARR number? And this comes to this whole thing of forecasting. If you can't forecast, then you don't have a valuable business. And by the time the actuals come in, it's all too late. You can't do anything. You can only do things if you're forecasting and forecasting accurately. Then the next thing on the report should be, what is the budget by quarter for quarter 1, 2, 3, and 4? And what are you forecasting for each of those quarters? So you're starting to drive down to the quarter level. And then the next thing after that would be the ARR by month. And then after that would be your other key metrics by month. So maybe what is your debtors running at? What is your churn running at? What is your LTV to calc running at? Whatever. So on one page, you can quickly tell how the company's performing. And everyone has not lost sight. We are growing the ARR at 70% a year. This year, this is the ARR we've agreed to in the budget. This is what we're forecasting, and this is what we're forecasting for, say, Q2. And this is what Q1 came in. And then these are what the other metrics are looking like. So you don't need to go and dig it through the page. And that should be the opening conversation. Then the next thing should be, what are the half a dozen strategic projects you're working on? What is the target date? What is the revised date? Is it green, red, or whatever? Because they're the projects that move the needle. So that to me is the key of the one pager. And you want the CEO to own that, so that if it's not meeting what it should be, then talk about that, and talk about that to board, talk about that to investors. And you should talk about that to staff. So everyone's on the same page. It's about sharing the vision and just sharing how you are progressing against that vision. And it's about not hiding. And if you're missing your numbers, then the sooner you raise your hand and say, we've got a problem, and the sooner you start to address it, the better chance you have of fixing it.
What I like about it is initial conversation at the beginning of the board meeting helps guide what the rest of the board meeting is going to be. Because if you're ahead of numbers or you're making numbers, then the conversation during the board meeting is going to go in one direction. But if month on month we're slipping behind, we then need some really functional conversations about what are we learning? What do we need to be doing different? What are some of the changes that need to be made? Because if we keep falling behind month on month, then the problem is in that top left corner or top right corner, wherever you put it, year 2, year 3, year 4, year 5 becomes that much harder. And rather than waiting till year 2 and year 3 to realise how far we're behind, I just think it's really important and powerful that the board meeting is functional every time.
And I think the board meeting needs to be structured so that upfront is that one pager and then the discussion that follows from that. And then after that, you then have all the normal guff that happens at a board meeting, action items and reviewing the actions, and it's looking through some of the operational reports maybe and the recommendations and the other governance things, but they're later. And you might spend in a 2-hour board meeting or 2.5 board meeting, you might spend, because there are problems, 2 hours on the first thing, and then you only spend half an hour to do the other ones, and you'll just go through them very quickly, rather than the other way around, which is people spend most of the time on all this other stuff. And then the big issue is buried in the paper. And by the time you get it, people are tired and they've got to go to other meetings. And so it doesn't get the attention it needs. And if you're not meeting your numbers, that is all that matters, to be honest. That is the number one conversation. And then you look at what the cause is. Is it the people? Is it process? Is it structure? Is it strategy? They're the 4 things I always look at. If things aren't working, people, process, structure, strategy, something's not right. And we need to make some hard decisions. And kicking that can down the road doesn't help anyone. You've got to make those decisions, and you've got to make them quickly. And I'm a big believer that making a decision, even if it's the wrong decision, is better than making no decision. Like, you don't want to be kicking those things down the path. If you make a decision, it's the wrong decision, you'll quickly see it's the wrong decision. You can pivot and you can then make another decision. But kicking that can down the road, and I've seen that with some of the startups, they have a fundamental problem. And look, let's face it, the biggest problem a startup has is sales and meeting their numbers and growing their business. And I see that they just push that can down the road month after month, not making any dramatic changes. His job is to force that serious, hard conversation and not let the meeting finish unless there are some significant actions coming out of it.
Yeah, it's really interesting seeing some board meetings where the meeting is almost just a reading of the board papers, and they get to the end of the meeting before they've actually identified the issues at hand, and then they have no time left to discuss. And I think your point about not kicking the can down the road also plays out in the mind of the founder or the CEO, who I almost feel sometimes it's a fear of actually sharing how things are, or maybe a naive belief that things will rectify themselves and come good, and then we'll talk about the targets that we've hit. But I think there is a psychological element there for a lot of CEOs who I feel like they don't quite understand the benefits of the board and how bringing these problems forward earlier can actually bring more minds in to solve it, and more guidance and more support. And there's a vested interest there amongst your board and shareholders to actually help you on that journey, rather than seeing it as someone that you're reporting to as a report card and going to be judged on, and therefore wanting to hide some negative performance.
Boards have to hold the CEO accountable, and then the CEO has to hold his people accountable. And if you've got that level of accountability, then people don't kick the can down the road. They have to fess up to their problems, and they've got to go find a solution. And there's lots of techniques you use to do all of that, but it's about accountability in the end. And I don't sit on boards anymore, but I did sit on a few for a while with other directors, and particularly VCs. I'm not saying the wrong way, but I used to see this bad behaviour where the founder wasn't being held to account, and they weren't doing them any justice. And initially I went along with it thinking maybe I'm the odd man out, but it clearly didn't work. And so I started to do what I've talked about, which is simplifying the board papers, having the page up front and holding the CEO to account, saying, no, don't get the CFO to talk about this. You talk about it and you tell us what you're going to do to fix it. And we'll either say we agree with it, or we'll challenge you on it and help you think about a different way to do it. So that holding that accountability is fundamental. If you want to build a successful business and you want to really scale it, that is critical.
And I think what's interesting is it's the what I think is quite clear, that most investors or VCs or anyone would say, yes, we agree that the role is to hold them accountable. It's the how that they often struggle with. And the how that I've watched you work with is you don't set them up to fail by not giving them support or tools or templates or report. You actually say, this is how I would like to see it done. And then, correct me if I'm wrong, your philosophy isn't, I'm going to tell you what to do, you better follow it. Your philosophy is, I'm there to help you think and to challenge you, but ultimately you're the founder that I'm backing, and it's up to you to go and implement, but I'm going to hold a mirror up to in a as kind of manner possible, but still strongly challenge you to think differently if you're not on the right track.
Definitely. In the end, every business is different, and the founder has to find the solution that works for them. And our job is to help them to identify that there is a problem and to bring the urgency to have that problem addressed, but then give them some advice. But it's up to them to find what is appropriate for their business, because they are all different. They're subtly different. So, it's got to be what's appropriate for that business. So that is critical.
You mentioned earlier that you ran, obviously there was a whole lot more to it, but Tech One got to it being a $5 billion business with this philosophy of a very short form initial report, the 2 pages. In previous conversations, you've talked about even when Tech One was a big business, that people had to still deliver a 1-minute pitch, and that if you couldn't clearly articulate what it is that you wanted to do, why you wanted to do it in 1 minute, don't bother coming until you've got that level of clarity. Could you unpack that a little bit for us?
Yeah, look, it's the same concept. The one pager at the front of the board paper, the one pager that runs the business, and it's the same as the 1 minute you get to talk to me with an idea, or 1 minute to present to the board. It's about getting absolute clarity in what someone wants to talk about. And if they haven't got the absolute clarity, then they're wasting my time or the board's time. And our job isn't to do that. So it is what I call the 1 minute rule. It's also the 1 page rule. If you put something in front of the board, it's 1 page. You might have appendixes, but they don't need to read the appendix. So it's getting that clarity of thought is really important. And look, it could be anything. It could be, we want to do an acquisition. We're going to spend $100 million. Okay, you've got a minute. Tell me why we would do this acquisition. And if you can't tell me within a minute the compelling reason to do it, then go away and think about it. Or we're going to build a new product line. Okay, tell me within a minute what it is you're going to do, or we're going to restructure part of the business. 1 minute is actually a lot of time if you've absolutely got clarity. I know it sounds audacious, but it's not. It actually still runs Tech One today. This 1 minute rule. You've got 1 minute to get your idea across, and you need to have absolute clarity. And that clarity then means when you present the idea, everyone can really critique it, and then you can get into more detail subsequent to it if there's interest, or if there's not, it gets pushed back. So it's a great time saver, but it really does mean you can see the wood for the tree, because people aren't going into the detail, and they're missing the bigger picture. So to me, the 1 minute rule, the 1 page rule is really important. And look, we ban PowerPoints, we ban big documents, all that sort of stuff. It really is about keeping it absolutely simple.
I absolutely love that philosophy. And the fact that you had that even for when it was a potential acquisition of a company, the ability to clearly articulate the what and why. I think it's a phenomenal tool. And the other thing you talk a lot about, Adrian, when we catch up, and it's distilled in what you've just gone through, but that need for a founder to focus, like particularly in the early stages, focus on one particular customer segment. But I'm keen if you could share a little bit more about that for founders out there, because often they are trying to chase many things, or they see opportunities everywhere. The natural entrepreneurial energy is to say yes to everything and to try and be all things to all people. Or maybe it's coming more from an existential crisis and they need the revenue in the door today, and it costs them strategically in the longer term. But can you just unpack that for a founder? How do they navigate and find that focus? Where should they be focusing when they first start?
Yeah, it's a great question again. Look, when you boil it all down, it comes down to time management for both you and for the business as a whole. And how do you effectively manage your time as a founder, and how do you manage effectively the time for the whole business? And so it comes down to a concept I call cadence. There's a cadence. There's a cadence for me as a founder of how I will spend my day, my week, my month, my quarter. And then there's a cadence for the business of how it will spend its day, its week, its month, and its quarter. And I'm a big believer that if you get the cadence right, both for you as a founder and for your business, you get huge synergies and huge flow-through benefits, because it's like a cogwheel. It's like a machine that is working very well. For example, I think ultimately the cadence for most business is not weekly or monthly, it's quarterly. And so what you want to do is you want to say, okay, we'll work on a quarterly cadence. So every quarter we will forecast what we're going to do for the next quarter and get the whole company to commit to the forecast. And then when we get to the end of the quarter, what we'll do is we'll reconcile and we'll see, did we meet our forecasts? Did we do all the things we said we we're going to do? And then you set the peg for the next quarter. And by doing that quarterly sort of cadence, it means that people can actually go and run the business day to day, week to week, month to month without a lot of interference, because they've got a quarter to go and do what they've got to do, what they said they were going to do. At the end of the quarter, you reconcile, you see who succeeded and who didn't succeed. You make the decisions with them of how you're going to fix it, and then you start the next quarter with your forecasts and your commitments in place. That gives huge synergy, and it means you're not micromanaging people, because that's the problem. That doesn't mean that your door isn't open. People come in and they say, hey, look, I need some advice and guidance. Great, let's have a chat about that. Doesn't mean you don't take them out for a walk or a cup of coffee. It's informal. The reconciliation point to me was every quarter. That was the cadence of the business. And so the business knew that cadence, and all the systems and processes were built around that. And the same comes down to your personal cadence as a founder. You've got to work out, what does your day look like? So for me, the mornings was where I had all my meetings that I had to have, and my PA would stack, rack and pack the meetings and phone calls and stuff. But the afternoon was my time. The afternoon was never allocated, and I would allocate it where I saw fit. So I might go meet a customer who's very strategic to hear what they were saying. Or I might go and work with the R&D people on a new project, like when we're building the SaaS. So that was my time to work on things strategically. And I think it's really important that you have that cadence, both for your business and you have the cadence for yourself in your own personal life. And my calendar would be scheduled out for a whole year ahead with holidays and everything else based around that cadence. And the business would have its company-wide calendar scheduled out for a year based around the cadence. And so people knew a year ahead when the company meetings were going to be, when the Village Green meetings would be, when the kickoff would be. That was all planned well ahead. And a year ahead, people would know exactly what was happening. So you've got to be that disciplined, I think, in running the business. So it comes down to cadence and time management. If you don't have those, you're just going to be running here, running there, and, all over the place.
Yeah, I really like that. I had a great advisory board member and mentor that when we were in the high growth phase, he asked me to pull out my calendar, and with great pride, it was just racked and stacked 18 hours a day for weeks ahead. He said, what I want you to get to is at the beginning of each week, whether you're an afternoon person or a morning person, you've got to choose, allow that to be racked and stacked. But if you don't allow free space in your calendar, then the important things that you need to be doing are going to get lost into all the other issues that come up. He said, you'll still work 100 hours a week.
Yeah.
You'll still work hard. But he helped me understand that coming into a week, having a really full calendar wasn't actually functional, and it wasn't something to celebrate. That was actually going to be ensuring that I was going to do a poor job as CEO because I wasn't available to go and do those important things. So I really like what you've said there.
I think also ties into the concept, do you want to be reactive or proactive? If you're reactive, it's very hard to be efficient and effective. Where if you're proactive, you are a lot more efficient and effective. And if you are being reactive a lot, and if you're under a lot of stress, a lot of pressure, these are all signs that you need to do something significant to fix it. And I'll come back to the concept mentioned earlier, people, process, structure, and strategy. Something's not working. So have a look at it and you better fix it, because working reactively is not the norm. You should be working proactively.
So double clicking on those ingredients then, you're on the board, you're advising, you're trying to hold to account. When there's a situation where clearly there is a problem with people, process, structure or strategy, is it your experience that the founders can always see that and highlight it? Or do you need to do further work for them to unpack whether the issue is in those four ingredients?
I find normally when you highlight that to people, the penny does drop, and you can see the signs. The founder's working long hours, they're under huge pressure, they're reacting rather than being proactive. Things are not working the way they should be. And I think that's where you say, this is not the way it should be. So you need to do something dramatic to fix this, because this is like an early warning sign that you've got bigger problems coming. And so then you just sit down and you start going through that. Is it a people problem? Is it process? Is it your structure? Is it strategy? And you start to unpack it. And we'll normally be in one of those categories that the problem exists.
Which is the hardest category? Which do you find is the hardest category for them to try and identify and resolve out of those four?
Strategy. If you're in the wrong, if your strategy is not right, people find that really hard to pivot and to change, to be frankly honest. So getting the strategy right, I find is much easier, because that is the hardest thing to change. Where people you can change, the structure you can change, your processes you can change. They take work, but strategy is really hard, because that's your compass. That's where you're all going. And if your strategy is wrong, and look, people don't want to admit to the strategy being wrong. I see it time and time again. The strategy isn't right, and it's just not going to work, And I think that's the tough one, changing the strategy.
Is it also the harder one to detect when it's wrong compared to the others? Knowing the data points to measure on that one? Or is it just that it is harder to change when it is wrong?
I think you see it because you can't forecast.
Yeah.
So you're not forecasting well. And so because you're not forecasting well and your actuals are coming in under, that's an early warning sign. So you might initially say, okay, we've got to maybe look at our process or our structure or whatever. But if it continues, then I think your strategy is what's a problem. And I'm a big believer, like companies that are worth a lot of money and that are hugely successful, they can forecast their numbers. They build the systems and the disciplines and the processes and the strategy to be able to forecast accurately. And that's where they get the huge valuations. And my rule of Tech One was I was never interested in the actuals. When the actuals came in, it was all too late. All I was interested in, what was the forecast? And when the quarter was finished, if the forecast didn't meet the actuals, then I wanted to know why they didn't meet the forecast, the actuals, because it was too late. A lot of CEOs spent a lot of time going through all the actuals, but I spent my time on the forecast and making sure the forecasts were right and holding people to account. And if we didn't get the forecast, then all I cared about was, why do we miss it? Because I can't do anything about it after that. The actuals are far too late. It's all about forecast. Talk about being proactive. Companies have to change and evolve. If you're growing a business and you're growing fast, the business that you were 18 months ago isn't going to be the business you need to be in 18 months or 2 years later. And so part of being proactive to me was to force change through the organisation. Because if you don't force the change through the organisation, then the organisation will start to have problems and issues. And then you get into this reactive mode where you're trying to fix things reactively. So I think, again, part of being proactive is forcing change through the organisation before it's needed. So at Tech One, I had a rule, which is, and we were a big company, and so the timelines might be a bit different if you're a smaller company, but every year I would restructure one part of the organisation. It was a rolling restructure. So 1 year it might be R&D we'd restructure, and we would be significant. And then a year later we'd restructure sales and marketing. And a year later we'd restructure our corporate services. And a year later we'd restructure our implementation team. So it was a rolling restructure because I knew that if I didn't do it, it'd all catch up to me, right? And then I'd be in the middle of all this mess. But if I did it proactively, then it could be a positive thing. So we'd get everyone in the room in a particular team and we'd say, okay, it's time for us to become better. We need to become a better R&D organisation. So what do we need to do differently? Are there new methodologies, new tools? Do we need to build new products? Do we need to adopt some new ideas and concepts? And same with corporate services. Go in proactively saying we need to restructure. You didn't wait till the wheels came off. So again, it comes to this thing of being proactive. As a startup, it's the same thing. And it's doing also one battle at a time. If you don't do it progressively, you end up on multiple fronts battling. I think it's important just to battle one front at a time. So maybe as a startup, you might say, we're going to fix sales and marketing up. And then once we got that fixed, we'll move on to R&D. And me, Don, the first thing when I got involved in a startup wasn't talking about R&D or consulting or whatever. It's about talking about sales and marketing. I always think that's the first place you start. If you don't have the sales and marketing right, then you don't have an engine to build a business from. So that's got to be the engine of the business. You start with that.
Yeah, I think I really like that rolling restructure approach for a couple of reasons. In my experience, whether it's in investments or my life working with founders, that if you can get a culture that's used to change, if you can get a culture that's excited by restructures because they know how it happens, so it's not uncertain. Restructure is all about growth and new opportunity. That makes them excited. And then it's just the way we are around here, whereas organizations that don't restructure regularly, it then becomes quite a shock. And the analogy I've often shared of why it's important to constantly restructure is that when you go and buy a big plant from the nursery, they didn't just grow it in the ground and then dig it up. They actually every year dig it up and move it and move it. You've actually got to get the roots used to those different environments. Otherwise, if you do a big dig up when it's large, it gets such a shock, it kills it. And so your organization is going to be much better if you're doing these rolling changes, rolling restructures, and using the calendar as a bit of a blunt instrument because you're being proactive, like you said. So I really like that rolling description.
And the thing is, you can get your mind into that area and you can start thinking about the next area. If you're in the middle of restructuring, let's say sales and marketing, but you know you're going to do, let's say, corporate services next, you're working hard with that team. And that's where you're spending, as I said, my afternoons, we spent a lot working with that team while we got the restructure happening. But my thoughts were also going to the next area, which would maybe be corporate services. And I'd start socializing with people in the company and the executives, what they thought was happening in corporate services. But you'd bank them one after the other. And the company got used to it. It's a very positive, proactive thing. There's one of the comments that we used to get all the time is how quickly the company changed all the time because we were forcing that change on the company, doing it proactively.
Yeah, taking that time to rebuild the foundations on a regular basis. That's really phenomenal. The other thing you touched on there is starting with sales and marketing. And just to change the conversation a little bit, one of the things we see with founders is they often use their own personal networks to get those initial sales, and eventually that becomes not scalable. Can you give some advice for founders who are in that valley? So transitioning from the boot lever of going to the existing networks, going to known contacts, where then they have to convert it into a scalable sales machine. Advice for founders about navigating that transition.
Look, I think in the end, it comes down to really understanding where you are focused and not being scattergun. I see so many companies with a scattergun approach. They build something and it can apply in a lot of industries and they just shoot out across all those industries. And we know that is really hard to execute. You need a lot of money, a lot of people, and it is really hard to make that successful. So I always say to them, look, pick one particular sector. So for example, pick, healthcare, for example, and really go deep in that sector and build the product out for that sector and understand what are the drivers for that sector, understand how to talk to them, communicate, and know their events, know their cycles, and really just own it. And then it's very well defined. We're doing healthcare, so you can go and look at all the hospitals and all the doctors and all that sort of stuff, and they become your initial pipeline. And you start to then work through that pipeline, and you start to then build the machine to harvest it, but also to make sure you get the right product fit, and the right pricing, and you get rid of all the friction, and you really become very good. Now, you might find, look, you picked healthcare, for example, and after 3 or 4 or 5 months, you find, look, it's just not right for you. Then, okay, then you pivot and you say, okay, rather than healthcare, maybe we go into this sector here, which is different. Maybe it's totally different. Maybe it's local government because you built an asset management solution and you thought healthcare was great, but you find it isn't. So you then try another sector. But it's better to own one sector because then it's really well defined and you know what you're building and you can go really deep and you can own that globally. It's better to own something globally and own a sector. And that's the advice I try to give them. That's a much easier strategy to execute than that we are all things to all people. And it doesn't mean you can't make that work, but it takes a ton of money and a higher level of execution excellence. And it's just a harder road to hoe. So really focus, I think, is the key. And then you start to work out how do we build a predictable machine and a predictable way of building that pipeline and harvesting it. And you start to then look at where the friction is and you start removing the friction. And there's friction in lots of places, in the style of contract you use, the way you do your pricing, all those sort of things. And by getting rid of the friction, you start to unleash the power of the machine. But sales and marketing is the heart of a great company. Now, I'm a tech guy, a software guy, but I got to acknowledge, like, it's sales and marketing that is the real heart of a great tech company.
Where do you think, so I totally agree with you that focus, and I guess it's experience that teaches you that owning something globally is much easier than being all things to all people. But we often just come up against the impulse is constantly more markets, more verticals, the more people I can be something to, the bigger my company can be. But actually we find it's the total opposite. Where do you think that sort of impulse comes from? And have you got any secret strategies on when a founder constantly keeps focusing on more rather than focus? Are there any tips you have for other investors on how you've managed to influence them, or you've just got to
look, I think
ride
as
it?
a startup, it is more of a challenge because you're finding your way. And so I think you look at things from tactical versus strategic. So if you have a deal that comes in, and we call that like a bluebird, right? That's not in your strategic market, then you treat it as a bluebird. You say, look, this is just an odd deal that's come in. And as long as we can do the job and we can do it, it's not going to change the nature of the business and the R&D effort, and we're not going to make any huge commitments and take on huge liabilities. Well, we'll take the bluebird because we need the business. We're a startup. But don't suddenly pivot the business because you've got this bluebird deal, and don't take on all these commitments to do with R&D and other things because of it. Understand what is strategic. So you're working and putting money into your strategic area, which let's say might be healthcare. And so you're really building that product out and you're working strategically. If a bluebird comes along, fine, take it. But don't suddenly pivot the business because of it. And I think that's the advice I'd give to startups. And you might have, 10 or 20% of your effort just doing some of those bluebirds that come through on the side, but they're not strategic. You're putting the majority of your effort, 80%, into that strategic niche that you are trying to really build and become the brand for, become recognized. And it's in that nuances, like when you start to understand a niche and you add the little bits and pieces that they need and you get rid of the friction and you talk their language, that's when you really find the gold.
You mentioned there removing the friction, and you mentioned two subpoints. One was the style of contract, and the other was the way you use your pricing. Could you talk maybe about that latter one, particularly in the context of and your background in enterprise level sales? Like, what are the ways that a founder can use their pricing to remove the friction from the sales process?
Look, I think the friction of the sales process takes lots of forms, and pricing is just one of those things. I'm a big believer today is to be very open and transparent with your pricing. I think that gets rid of a lot of friction. So put your pricing on your website. Let everyone see what the pricing is. The days of hiding your pricing and that sort of stuff is gone. And then people will trust you because your pricing's there on the website, and have your contract on the website as well. And really be open and honest to people. Like, it's a reasonable and fair contract I have. And if you want to change it, we don't do that because we are fair and reasonable to everyone. So they're the sort of techniques I think it's about. Be open, be transparent, because that gets rid of friction. Don't give discounts because someone puts you under pressure. That's bad behavior. You can't scale a sales team that does that. I mean, a sales team that discounts based on pressure they get from customers causes lots of bad business. You only offer discounts because people will give you certain behaviors, and those behaviors are listed again on your website. So you'll say there's a discount if you, for example, take a 2-year contract or a 3 or a 5, there's a bigger discount. There's a discount, for example, if you will be a beta site. There's a discount, for example, if you buy more products or you increase your usage. So discounts are there and they're published on the website and everyone can see they're behavioural discounts. They're not just because I'm a big company and I'm going to force it on you. And I think you want to get to the point where you're open, you're transparent. This is the way we do business and you need to stay to that, because it's not fair to treat one customer different to another because they're bigger. That's just not right. It won't scale, not anymore. Those days are gone. The biggest transition we had to do as an enterprise vendor was actually making that leap. And we did that about 5 years ago, where we just said, this is the way we do business. This is the contract. These are the prices. This is how you get discounts. And that's all we do. There was initially some pushback, but it died down very quickly. And then everyone just accepted it. And you don't want to be a customer that hears that you bought the same product as someone else and you got a better deal. How does that work? It's just not ethical anymore. Everyone talks. So
I remember
getting rid of friction. And that's when we did the restructures too. It was all about getting rid of friction within the business as well. So it's all about getting rid of friction. Friction is the killer.
I remember we had a conversation once and also a conversation with a portfolio company where you were talking about the implementation fee versus the SaaS recurring. And I remember this particular portfolio company had quite a healthy margin on their implementation fee. But one of your suggestions was actually de-risking that for the buyer and potentially rolling that into a higher SaaS recurring. Could you talk through that, like this de-risking for the buyer's perspective?
Yeah, it's about de-risking it, but I'd say it's about getting rid of the friction, because as an enterprise vendor, we would go in and we would sell a SaaS deal, like maybe $1 million ARR a year or whatever, and then there's implementation fee, which could be $3 million or $2.5 million, and that created friction in the deal, number one. And number two, it also added a lot of risk for the customer, because the customer had this implementation now and there was a fee we were charging, and if the project went over, then they would have to pay more, and it was just causing lots of problems and issues. So we decided, again, as part of this concept to get rid of friction, to say, look, we will charge you 1.3 million or whatever, and we call that SaaS Plus. And for that, you get not just the software, but the implementation and the ongoing maintenance of keeping the software running built in. And so we took what was an implementation fee and made it a recurring fee, which is better for us. But from the customer's point of view, it's also better as well, because they're not paying this $2.5 million up front to implement the system, because it's now built into the SaaS Plus fee. So that de-risked it from them. And if it took a bit longer for the implementation, then that was on our tab, not on their tab. Also, too, it just changed the nature of the relationship, because as well, we would say, look, why don't you start off firstly with a special contract? Now we'll give you 6 months. At the end of 6 months, you're not happy, you can just stop the project. And if you are happy, then you can then go on to a yearly or 3-year contract and get the discount. So it just changed the whole dynamics. And again, it's this concept of getting rid of friction. But I think that's the way of the future. People don't want to pay an upfront implementation fee. They want to just pay a fee, what we call SaaS Plus. And for that, they get the system and they get it up and running and working and continuing whatever's required to keep it working, which means we have to get better and better at implementing the system. And we have to get better and better at keeping it up to date, because we have now locked in a fee, a recurring fee. And I tell you what, organisationally, we started to restructure the company behind the scenes so that we could become better at making the implementations faster and quicker and less risky, because we were now wearing that responsibility. So it really changed the business quite dramatically. And I think you find that the more you take on, the less friction the customer has, the more you take on, then the better your company will become as you do that, and the easier the sales become.
Yeah, that last point's a really interesting perspective, like that transitioning the risk over internally, forcing you to then have better practices to streamline your processes, not just de-risking it for the purchaser, but actually the secondary flow-on effects for you as a company and your teams, and focusing around making those processes more efficient.
Our teams are now being restructured around each of the implementation points. And so we see what's happening as we implement the software, and we say, if we automate this, or we add this piece of functionality, or we add this tool, we can reduce the implementation by 20, 30, 40%. And because we're on the tab for it, well, if we make it more efficient, then we actually improve our margin. So it's a fundamental restructuring of the business as well that goes along with that. But this ties into this other concept, which I mentioned. The company has to constantly change. And so you start looking for those changes, not just organisational change, departmental change, even look for company change. You say, how can we lift the ante? How can we become a better company? And you say, obviously, if we take on the implementation risk, we become a better company. And so that became the next big goal for the company, just like becoming a SaaS company. So you're always looking for how do you change? How do you continue to change and evolve and adapt and become better? You can't just do the same thing that you did 3 years ago and think that you're going to still be competitive. If you're not changing, you've got a problem. You need to change in very fundamental ways, and you need to facilitate that change.
Got a bit of a vibe to it. It's that saying, if you want to take the island, you got to burn the boats.
Yes.
And yeah, setting yourself up where you know you're going to get pushed and you're leaving an easier, more cushy life, but it's going to be good for you is really important. One of the challenges during the growth phase is founders often, once they get the people on board, they got to get the remuneration structures. And at the early phase of the journey, people generally start with fixed remuneration, but then bonus structures need to come in, performance incentives, and we've seen those work well, and then we've seen those blow up companies. Do you have any insights on getting remuneration linked into the whole accountability and performance framework?
Yeah, no, it's a good question as well. I think it's really important that as companies become successful, that the people that make it successful also become financially successful as well. So I think it's important to interrelate that. And I think it's also important to be upfront with people when they join the company. This is where we are, this is where we're going. You know, remember I talked about having the one page and having the key metric like the ARR for the next 5 years. So it's just not something that you use internally. You use it when you're bringing on people as well. We're going to go from 5 million ARR to 50 million next 5 years, which means this is going to become a very valuable company. So you want those people that are going to help you go from where you are to where you want to be. You want them to share in that success. And so things like having options are very important, but also I think having the incentives as well. And so at Tech One, we typically pay low bases. So we wanted people to come in that really shared the vision. And so we gave them a low base, but then we gave them huge incentive upside and options. And that's where they made their money, was in actually be participating in the growth. And as part of that too, we said to people, we will never renegotiate your incentive package. So as you grow that part of the business and becomes more and more successful, we're not going to say you're making too much money and we're going to cap your incentives. We didn't believe that. We had open-ended incentives, and we had people that joined the company and started off on a package worth X, and within 5-6 years their package was worth 4X. But we were happy with that because they had grown the business, and we wanted them to be successful and financially successful because that was good for the company. But on the other side too, come at the accountability thing, we're really clear to people, if you can't do your job, then you need to go, and we would move them on. So it wasn't like you can stay here if you're not delivering the results either. You need to be upfront. You're coming here to help us grow the business. If you grow it, you're going to make a lot of money. We're not going to cap your incentives. But if you don't, then it's time for us to part company.
And in that parting of the company,
you can imagine it's a public company. That didn't go down too well because people didn't like uncapped incentives and they didn't like low bases and all that sort of stuff, because they saw that's encouraging risky behavior and stuff. But if you've got the systems and the processes and the disciplines around it, they can't blow up the business.
I think that's the key point that I would just add, that the right time to be able to bring those uncapped scenarios in is at least in parallel when you're bringing some systems and processes and some guardrails to make sure that you can't get into trouble. Having open-ended things that have no guardrails, no systems, no process, often it's around measurement. Really early stage companies often don't yet have the data and the systems and the measurement tools to really effectively have some of those KPI-driven REM structures. And so making sure that you get the sequence right of, it's important to my growth that I attract the great people. The great people want to have some good upside. A foundation of that is going to be the systems and process to measure it correctly so we don't end up in conflict, making sure you get that sequence right.
But I think the other part of it comes back to this rule of keeping it simple, keep it really simple. So in our case, for example, there were two metrics that we cared about, which was profit and ARR. And so incentives were all tied to profit and ARR. That simple. And they're the two metrics we measured minutely from what was our profit and what was our ARR. And that's how we set the packages. So we didn't make it complicated. We didn't have a lot of airy-fairy stuff in there. We didn't have a lot of esoteric metrics. It was just the metrics that drove the business. And they were the two metrics, was ARR and profit. And so that's how we set the incentives. And because we didn't change the incentive every year, it was actually much easier on the business. You didn't have to go through this whole negotiation process every year and create all this bad blood. It was just another year starts. Same package, guys. The more you sell, the more ARR we get, and the more profit we are, the more you make. So everyone's on the same page.
Nice. When inevitably it is time that the person needs to be released to industry because it's just not working out, sometimes founders find it difficult, at least early on in their journey, to have those conversations and to do that, I guess, the right way. What's your sort of advice when on the people, clearly the process is fine, the structure's fine, the strategy's fine, but the person just isn't the right person for this particular role? What's your advice to founders of how to handle that?
Yeah, you've got to become good at it, because if you're growing a business, growing fast, just as I said earlier, just like the things you were doing 5 years ago aren't going to be good enough today because you're scaling the business. Quite a lot of the people that you had 5 years ago won't be the right people now. So you've got to become good at how to identify those people and how to exit them. And it has become a lot more complicated. There's no doubt about it, because of all the IR laws that have come in and unfair dismissals and that sort of stuff. And they do now apply to people that are on $1 million plus packages. So that becomes the tricky thing. What I find, though, is that if you're very clear upfront why you brought someone on, for example, let's say they're a regional manager and you're very upfront that they've got to grow their AI 50% a year or whatever, then there's normally not much doubt if they're not meeting that. And then, it's about sitting down and just having that conversation and finding a way to separate, a way that lets both people part on good terms. But you'll always have one or two people that will be very difficult. That's where it can become litigious and can become challenging. But you've got to become good at doing that. But it does tie back to being very clear up front when you're hiring people, the sort of relationship you want. You come in, you're going to grow the business, and these are what I expect. This is the key metric. And then you just reinforce that all the time. Because as I said earlier, like just at the board level, we had the one pager. That concept one pager then flows through to each department, each region. They all have their one pager. They all know what their 5-year number needs to look like, and they all have their key metrics and stuff. So it all flows down. The one page at the high level becomes a one pager at each department, which then becomes a one pager for each region. And so everyone knows the game up front before you put them on. This is what I expect. I expect this number from you over the next 5 years.
Adrian, one of the challenges in the growth phase, at a certain point, there's a difference between leadership and management. What are your views on those words and how do you approach it?
Yes, no, definitely. I've seen that firsthand. And just to relate a personal experience, when we Tech One and we listed it on the ASX, before we did that, we had to fix up a lot of our hygiene as a business. And so we were pretty much a fairly scrappy company, moving heaven and earth to do things. And so we brought in quite a number of professional managers, and they really fixed up the hygiene of the business, So we got really good at planning and scheduling and all that sort of stuff and managing risk. But it was interesting that after a couple of years of being publicly listed, I had really good people leaving the company, and I had customers really unhappy about what we were doing. And when I asked the people that were leaving and the customers, they said that we just weren't delivering what they needed anymore. And so it was very interesting, because I thought this could be the end of the company. That's how serious it had become. When I talked to the managers, I brought in the professional managers, they said, we planned and we scheduled and we got it wrong. And so because of that, we delivered late and we didn't allow enough risk, and the technology was a lot harder to use and that sort of stuff. And when I heard that, I knew that we were going to go out of business, because companies that we compete with, Oracle and SAP, they didn't care about our problems. And our customers, they don't care about our problems. They just want the product delivered on time. They want the features, the functions there. So to me, it was really a wake-up call. And so fundamentally, I came to realize that the company we had been was more a leadership company, and we'd become more a management company. And so we needed to go back to become a leadership company. And if you look at Tech One today, it actually has got both those components. And I think that's a good company. So we have the managers that run the business. So whatever the current business is, they're running the business, doing the hygiene. And then we have the leaders, and the leaders are really building whatever the new thing is, so the new business. So when we built the SaaS business, we had the leaders doing that. And the leaders don't plan and schedule to come up with the date, which is like 10 years in the future. We work differently with the leaders. We say, okay, we need to get the first version, for example, of this, maybe the SaaS business, out in 12 months' time, and we'll get it out to early adopters. And then over the next 12 months, we'll refine it. And so how can we go and do that? And so you work backwards from the endpoint to come up with a strategy and a way to do that. And so you've got to be very innovative and creative, and you need to have people that are prepared to work in a bit more unstructured and ill-defined way to get there. And I think that's the fundamental difference between leaders and managers. Managers are very good at running a steady state business, and you need them. So Tech One is really scaling very quickly. And so we have that part of the business being run by professional managers. But then the new stuff that we're doing is run by the leaders, and they take a very different approach. They start with the endpoint and they work back to how to get there. So it's a very different way of doing it. And leaders typically have very strong technical skills, whatever that area is that they're leading. And they're not afraid to roll up their sleeves and to get in and to work with their team. And a big part of their job is to keep the team positive and to push them through and to help them find the way to the end point. And there is no excuses. There is no, we can't get there. It always reminds me of Winston Churchill and his famous quote, we will fight them on the battlefields, we'll fight them on the beaches, we'll fight them in the streets and the hills, but we will never give in. That is, to me, the classic leader approach. So they are very different examples. And even a more recent one is take SpaceX. Look at Elon Musk. He built the space business from scratch when people said it couldn't be done. Like he was putting the rockets up and they were blowing up and they were learning from those mistakes, and then they were putting the next rockets up and away they were going. He was taking a very much a leadership approach to that, where if you look at the other major provider to NASA, which is Boeing, I mean, they plan, they schedule, they go round and round and round before they put the first rocket up, and, look at the difference in execution, difference between leadership and management.
And so for Technology One, transitioning to more of a leadership company, was that about finding new people or replacing people structurally? Was it a people or a structure issue or both? And how did you identify more of those leader types versus the manager side?
I think when you start a business, you naturally have to be a leader to start a business, and you're typically a bit more unstructured, and you bring people on that are like you, that have that more leadership approach, and that's how you actually start to build a business and scale it. The problem was when we started to bring the managers in, because we wanted to improve all the hygiene and that sort of stuff in the business and the systems, the processes, and get the invoices out on time and all that sort of stuff. That's where we started to lose our way, because the managers were starting to blunt the leadership team that we had. And that's why I was losing these good people, these really talented people, because they didn't want to work in that environment. So they were the people I was trying to keep. And so that's why I ended up realizing this is the steady state business. And so that's where the managers will live, and they run the bulk of the company. And then this is the new business we're building, the new products or whatever. And that's where I moved the people that were the leaders. They stand out very clearly. They're the mavericks, and you put them into that part of the business. And it's a little bit less structured and a little bit more iterative and that sort of stuff. And you make a lot of mistakes, and you're learning from the mistakes and stuff. So they are very different people. And when we recruit people, we look at where they fit in based on that profile. Those people that go into the new business we're building, and those people that go in the existing business. And the new business or the new product or whatever it is we're building at some point has to be then transitioned into the main business, because that's where it will then be able to be scaled, because the managers have the disciplines to scale that, where the leaders don't. The leaders aren't really good at scaling something. They're good at building it, and they're good to get the early adopters and to get the product just right and working well. But then when you get to that scaling phase, you need a lot more discipline and systems and processes. And so then you transition it into the main business. So it's good. You have those two different parts of the business.
We're conscious of time. So to wrap it up, we have one question to end with, which is actually from our analyst, Jack. Don, do you recall the exact wording of Jack's question?
Yeah, unfortunately, Jack's travelling, but I guess he's after the secret little sauce. Notwithstanding everything we discussed, what is your view of what really makes a winning SaaS business versus a losing SaaS business outside the normal things around the product? Is it just everything we've discussed today, or are there some other key features that for you, this is going to be a winning one and this one's likely not to?
Look, when I look at a SaaS business, I look at it differently to probably how a lot of VCs look at it. I look at the very first thing is the strategy. Do I think the strategy will take them into the blue ocean? And is it a strategy that will be reasonably simple and straightforward to execute? And then the next thing I look at is the founder. Is he the sort of person I want to be in business with? Has he got the sort of traits that I look for, that he's going to have the perseverance, the drive, the ability to change, to pivot? Is he honest? Is he a nice person to work with? Is the sort of person I'm going to enjoy working with? And they're the two most important things for me. It's the strategy and it's the founder. Then the last bit is the execution. If you've got the right strategy and the right founder, and you've raised enough capital and you start the process properly, then execution normally you can make work, you can fix. So to me, it's the last piece of the puzzle is the execution side of it. So it does come down to the strategy and the founder and personal traits. That to me is the key thing I look for.
Totally agree. And thank you, Adrian, for all your time and insights today. It's been another fantastic conversation. I always feel like there's so much more that we could talk about and dive deeper into. But this has been incredibly valuable, no doubt, for founders and also for investors to gain insights to some of these things, particularly around those board discussions. Lots of investors end up sitting on boards, and understanding how to unpack some of that data and get their founders to report in a certain way. It's incredibly valuable. So thank you for your time.
My pleasure. Always a pleasure to catch up. See you, Aaron. See you, Don.
Thank you, Adrian. Appreciate it.